Welcome to the Market Pulse podcast. I'm your host, Emmaline Aliff, leader of the Equifax Advisors. As a group, we identify economic considerations and leverage data and analytics to translate into industry insights and recommendations with the goal to support our clients during economic uncertainty while uncovering growth opportunities in consumer and commercial credit risk. I'm pleased to welcome back our panel of experts in the advisors team, Tom O'Neill, Dave Sojka, Jesse Hardin, and Maria Urtubey. Welcome.
Hey, Em.
I
Hey,
am.
Em, how are you? How's it going?
Yeah, it's going well. One of the things that comes to mind for me, we've had our Thanksgiving holiday and we're heading into other holidays depending on what you celebrate. Is I've been personally actively starting to use AI more, specifically with trying to find activities to do with my children because they're all older now. My youngest is 14, and the things that I like to do with them for is pivoting away from presence and doing more experiential things. And so I've been leveraging AI to identify things to do, and we've gone down to the botanical gardens, and I'm trying to find things that what will teenagers enjoy that I will also enjoy, and it's really been helpful in that regard for me. What are some ways that y'all have been exploring different pathways for this holiday season?
I'm not sure it's holiday specific, but it is timely. So we have a 15-year-old as well, and he's driving. So we just got a permit, and being the spreadsheet lover that I am, I know we have to track his miles and hours in the driver's seat. So I actually used the Chat GPT function to figure out how to code, and did a little JavaScript. So kind of fun. Certainly opened my eyes to the realization that there are lots of coders that are probably at risk based on the flexibility that AI brings.
Very
Well,
cool, Jesse.
my kids are older than 15. They're moving out now, so I suddenly have more time on my hands where I'm not driving them to practice or to dance or to things like that. So I've been doing things like sort of brushing off some of the music writing, that I had enjoyed doing, and trying to get my Spanish up to speed, and then of course trying to blend the two of them, which is kind of a disaster. But I thought, wouldn't it be cool to do a Spanish song, which didn't work out very well. But I turned to AI, said, okay, well, take my English lyrics, put it into Spanish, and help me put this into song. Give me some ideas around putting this, and it actually turned out really nicely. I'm kind of
That's cool.
kind of pleased with the end result. And so I'm thinking, oh, I might try Russian next. Who knows?
Yeah, it has been very helpful from a language standpoint. My trip to Colombia was very similar. I had missed my flight back due to a delay, and my AI was able to help me find all the things I needed to do in a foreign land. And I don't speak Spanish, so I have a lot of hope for your song, Maria, the actual Spanish speaker.
I'm continuing on the teenage needs and the use of AI. I'm currently, and that's why it's a little dark, time difference. I'm in Buenos Aires, here for the holidays, and I have the teenagers and an added on extra visitor. A friend of my son is coming as well. So I've been using AI to plan how to best optimize the 10 days that he's visiting as a tourist, but doing things that will be, tempting and fun for a teenager, an 18-year-old teenager that is coming for the first time. So that's how we're looking into the use of these tools.
And I made the fantasy football playoffs in three of my leagues that I'm
Wow,
in.
Wow,
So
three for three.
that's
I decided
impressive.
to try I decided to try leveraging AI, even though I pay for sites to help me optimize my lineups. I actually leveraged AI to say, okay, given all these choices, who's going to give me my best option for victory? So we'll see if Gemini is smarter than the experts.
So you're abandoning your season-long strategy that got you into the playoffs to go down a new strategy. I'd love to see. I
There
can't
were
wait for the outcome.
yes, we'll see.
It's very, very bold, and I wouldn't expect anything different.
Yeah,
Can I say
can
I'm
AI give you Better insights into Christian McCaffrey's hamstring than the experts. Yeah.
Can I say
All
I'm
right.
rather surprised that nobody actually said anything about shopping on AI? It seems like that was a trend. I saw somewhere where you could actually put in a little piece of code in an AI and it or in one of the generators and it would find the best deals for you. I didn't do it though.
Well, you still have time. You still have
Yeah,
time.
yeah,
Yeah.
there you go.
So, in this edition of our Market Pulse podcast, we want to talk about Santa's scorecard. So, what's been naughty or nice this economy for 2025, and what are some potential resolutions in 2026? And we're going to do this a la a white elephant style of economic topics. So, before we jump into that, I'd like to welcome Shandor Whitcher from Moody's Analytics to share a quick economic update.
The US economy is still expanding, but that expansion has become increasingly narrow. Inflation remains too high, growth is slowing, and the benefits of economic activity are accruing to a shrinking share of households. That disconnect is at the heart of why so many Americans feel worse off, even as top line growth and financial markets suggest the economy is holding together. Prices for everyday necessities, groceries, insurance, electricity, car insurance, and healthcare remain elevated and in many cases are still rising. At the same time, income growth is slowing, job growth is stalled, unemployment is edging higher, and workers have less leverage than they did even a year ago. The result is a growing gap between the cost of living and households' ability to keep up. Consumer surveys reflect this strain. Measures of consumer sentiment and confidence are back near levels last seen during the pandemic shutdowns. While politics undoubtedly color these responses, the underlying message is consistent. Households feel squeezed, especially when thinking about the months ahead. So the problem's not new, but it is intensifying again. Inflation surged during the pandemic, eased briefly, and now appears stuck around 3%, well above the Federal Reserve's target. And recent policy choices have made that stickiness worse. Higher tariffs, restrictive immigration policies, and broader deglobalization efforts are raising costs, limiting labor supply, and weighing on productivity. So together, they keep inflation higher than it otherwise would be. Now, to the labor market, businesses aren't broadly laying off workers, but hiring is slowed to a crawl, hours worked are being cut back, and unemployment is rising, particularly for younger workers. So this all contributes to that K-shaped economy we've heard so much about. So higher income households are still spending freely, supported by strong balance sheets and asset gains. But the bottom half of the income distribution is struggling, increasingly reliant on credit and showing clear signs of financial stress. So our base view is that the economy will slow in the year ahead with weakening job growth and higher unemployment. At the same time, inflation is expected to heat up, but for the economy to avoid a broad-based economic downturn. Now, that said, the economy remains in a fragile position, and it won't take much to send things sideways.
Thank you, Shandor and Moody's Analytics, for your help in describing the economy for us. So, over the last months in our podcast, we have discussed key economic themes, many of which you just heard the latest updates and predictions. At the beginning of the year, is something that we covered all the way down through the health of the consumer through mid-year and now towards the end of the year. Today, we want to talk about what transpired in 2025 regarding the things like economic policy shifts, the changes that we observed in hard and soft economic data, and recall some of the things that we may have predicted at the beginning of the year of things that were happening. And so, as I was saying before, in keeping with holiday season, let's treat this like we're opening presents. So I think how we're going to operate on this is from a white elephant standpoint, be able to address the topic of the gift that you received from me, and you can present it or describe it as a lump of coal or something that you are have been looking forward to as a great present, and then we can come at the end and do some round robin types of things for for how we're viewing each of these topics. Okay.
So, Emmeline, in true white elephant fashion, if you throw us a topic and we want to pass it along, can we do that?
And we
Someone can steal
steal.
the topic.
Yeah, someone steals the top. Yeah, there we go.
Yeah.
Okay.
All right. So
Right.
we're gonna start. So I have like my list here, and I'm gonna start with Dave. Okay. Dave
Well,
got
hang
the
on. Did
lucky
we
draw.
We were supposed to vote. Weren't we supposed to draw numbers to see who goes first?
Oh,
Well, we didn't do
No,
that, so
he
I had my I had I
All
had
right.
names in a hat here, and the name that I pulled out is Dave.
We'll give it to Dave.
okay. All right. So for those of you audio listening, you're not seeing this, but I do have a present. So I'm going to reach in my bag and see what Emmeline just gave me.
Well, I didn't give
Oh,
it to you yet.
you did? I thought you just did.
No, but I'm about to give it to you.
Okay.
You're yeah. So the present that Dave receives today, and you as you choose to open this, you I think you have to address this one, but others can steal the topic away from you after you do a little overview. So what I'd like you to talk about today, you get AI adoption at both personal and industry levels and some of the potential impacts that it might have in the economy.
Okay. All right. So again, I'm going to look in my present here for that AI impact. And I see, I see positive impacts. And looks like there's three so far for the economy, and one of them would be a fundamental economic shift. The second one says long-term growth of between 1.8 and 2.5% annually, and the third says, uh, projected improvement of debt to GDP to almost 40%. Wow, that's pretty good.
Okay, can I steal?
Sure.
Yeah, jump on in. So we
All
we have
right.
our first
There you go.
gift steal of the
So
day.
so
So wait,
so
before we move on, I didn't explain the ground rules. You can steal once as we go through the round, and then you can hop in otherwise. But Tom, you have to wait for others to steal first, and we can treat it kind of like an auction if we need to.
Firstborn.
Now Tom's deciding whether or not
But
he wants to
you got the
steal.
steal. You already called it. Go.
okay. So I'm lost. All right. So if I steal, does that mean that I have to look at Dave's present
Yeah.
and
Yep.
term it a lump of coal, or um, because that's
You
what I was
can
going
do
to
either
do.
one.
Yes.
Go ahead and do
All
it.
right.
I think
Yeah.
that's
All
appropriate.
right, because Dave looks at the AI adoption at at both the personal and the industry levels as a series of presents, which I get. It's nice and shiny and looks cool and all that stuff, but it has the real potential of being a lump of coal as well. We talk about that fundamental shift in the marketplace and in industry as if it's just a good thing, which there are positives, but it is a shift, and that always brings about change, by nature. And there will be those who benefit, and there will be a lot of those who don't benefit and are hurt by this. And so there are going to be, changes on the job market, level in terms of new opportunities, for advancement and for new careers that we haven't even thought of yet. And there's also going to be those that are impacted because a lot of their work is now redundant or taken over by AI. And so when we look at the aggregate, it's nice to, it's nice to look at this as a bright shiny present, but for many this may be a lump of coal.
Mm.
Yeah.
I'm going to comment.
Any other points to add there before we move on to the next
Yeah, I want to
president?
comment real quick. I think I'll just I'll shed light on the present that Dave got and then the coal that Tom just alluded to. I do think it calls into question remembering that this is a new technology. It takes a while for us to find full adoption of new technology, and so I do think one of the interesting things is to see that from a technological standpoint, AI right now has been a bottom-up approach. So we've seen a lot of adoption at the individual level. You see households using AI to make better decisions. We just talked about it. And so that's interesting to me. It's interesting when you think about the bottom-up approach, whereas a lot of technologies have come from top-down. They've come from corporations and governments, and then they push those down to the average person. So that's kind of interesting to see. But I do think it's going to take a little bit of time to really get a feel for where we're going with AI.
Yeah, and I think how things move and evolve in that is going to be highly dependent on the development and continued growth in critical thinking skills. Because I think it's things like AI are only as good as the ideas that you put into it and your interpretation of that. So next present, I'd like to let me look at here whose name I'm pulling. Jesse.
Ah, there we
So
go. Number
Jesse,
two.
you are going to get. Let me see here. Uh, How about this is a light topic. Rate cuts. React to that phrase.
Mm.
Rate cuts. Well, it's interesting because I guess, another present yesterday, right? We got another rate cut. Maybe not so much of a present when we look at the commentary behind the rate cut, potentially looking at a slowdown of rate cuts next year. But yeah, it's hard to debate the fact that the rate cuts that we got this year have really helped. So, what we're talking about in general is monetary policy. So the Fed controls monetary policy. They raise rates when they want to slow the economy down. They lower rates when they want to stimulate the economy. And so when you think about where we are, we saw three rate cuts in the year, sort of getting back to some equilibrium rate where the Fed feels comfortable enough with prices and their dual mandate. The second part of that dual mandate being full unemployment or full employment. And so we certainly have, I think, more of a concern right now with respect to where employment is and growth in jobs. That's probably something that's going to be very important to watch. And I may have been stealing my look ahead for next year, but certainly I think the rate cuts will help spur loans. People can go get a car, they can get a house at a cheaper rate, and the bigger concern certainly is going to be, do we see any additional rate cuts next year? And the Fed's going to be looking closely at that. But yeah, I like my present. Nobody's stealing
You
it from
do?
me.
No,
Well,
I'm adding
yeah. Go ahead, Maria. Yeah.
no, I was going to add a comment, and Jesse, you mentioned mortgages. Definitely, that's the one that we've been overseeing and trying to see to what degree these rate cuts over the year will affect them, because there are some areas, depending where you're located. Not right now for me, but in Northern California where I live, and just as in New York or Miami, even we were reading the other day and we were sharing that even a 0% interest rate on a mortgage might not even facilitate access to a medium mortgage loan for a medium income household. So it all depends, going back to our K that we've been discussing for the last 3+ years, it all depends where you're situated in that portion of the K. If you're in the bottom, it might be more of a struggle still.
Yeah, and then just to kind of, well, I'll say close it out, but maybe others will chime back in. From the consumer side, right? The rate cuts aren't immediate relief to them. And so that's always a big topic is, am I going to see an immediate reduction in my credit card rate? Am I going to see a reduction if I'm looking for a new or a used auto loan? Maria just touched on the mortgage side. So that tends to lag several months. So, I think, the popular opinion is probably not until we get into, maybe the end of Q1 will we start seeing some relief, but I think it's the hope that the rate cuts offer.
Yeah. Can somebody? This is a bonus gift for y'all. Who's got the update on the yield curve?
Yeah, I can take that. I'll take my bonus gift. So yeah, the yield curve has reinverted, I think, as of middle of the year. So
Okay.
we're
And
back
it's
on
holding around there.
yeah, back on a normal trend.
Okay. All right. So remember, yeah. So Jesse, I think you're reviewing that as a wonderful present so far. That rate cuts have happened, mainly because we haven't seen such a negative impact to either inflation or to the labor markets. Now, some things, time will tell with respect to how the labor markets continue to potentially move, as well as inflationary impacts from things like tariffs, et cetera. But we're not there yet. Okay. So
And I
just giving you
can't
some foreshadowing.
and I can't steal it and present it as a lump of coal because I already used my steal, right? I'm
That's
in a
true.
very
Done.
good
That's
You're
true.
spirit.
done.
Yeah,
Yes, all
but
right.
you never know. There might be other topics with other
I'll
other
bide
gifts
my
that we
time.
have.
Yep.
And for
All right.
those of you that are watching, we some of us, kind of dressed up festively. We didn't tell Tom that he had to dress up like a lump of coal.
This is just I am the lump of coal today.
That was a
Yes.
coincidence. That was all
Yep.
And I
coincidental.
do have I do have all my colors on for the holiday season. So for the next gift, I'm going to keep in mind this could be either a coal or wonderful present. The last two, I think, kind of more landed in the wonderful present. So maybe we have a coal coming here. Uh, the next person is going to be Maria.
Ooh.
So I would like to ask you, maybe you can comment on what present here. Okay, student loan delinquency impact. We've been talking about this topic for quite some time. Like, what is your view in terms of borrower stress, confusion, et cetera? Like, what is the temperature on that currently?
Oh, so much to uncover there. I think it could be viewed as a code, given it impacts over 42 million consumers that hold 3 to 4 student loans, given it spreads across generations, even though millennials hold the highest share, even though Gen X holds the highest delinquency rates, but it's Gen Zs that hold or have to carry the highest share of the debt when the payments resumed last October. So it could be a call with the possibility of course, juggling this new debt wisely and getting, of course, rewarded from that extra behavior showing in your report. But in most cases, what we've seen is that the historic delinquency we've hit in May was the highest over the last 20 years. So clearly, it's been more of a cold than a positive side. We've seen that some consumers have had their scores decreased by over 100 points as a result of missing payments, which is a very big hurdle to deal with when you're trying to access other credits that you might need if you're at the bottom part of the K. So it has all its implications. And there's an added on uncertainty, as you were saying, Em, both from the servicer, changing circumstances on servicer. This Tuesday, there was a new one that the saving plan might be stopped in February, and that would result in some deferred student loans coming into repayment as well, affecting 7.6 million consumers. So all over the place, there's a lot to take in and a lot of juggling pieces. So I could think it's more of a call versus that small group that can still benefit from, of course, responding, paying as agreed to this commitment.
I don't know how we spin that into I want that present. So Maria, I think you're kind of stuck with
Yeah,
that.
I think you're stuck
I'm
with that
stuck.
coal. Yeah, you're stuck.
Well,
Sorry.
I think the way it goes is Maria can steal somebody else's good present now, right?
Yeah.
Yes.
She can, she can.
'Cause
Yeah,
I
and
think
I
you'd
didn't
have
even
you'd
talk about garnishment. So that's another one that is looming on
Yeah.
the student loan coal.
I think you'd need some eggnog with some pretty stiff additive in that if you want to take that one as a present.
And given that I think we gone all around the room so far as everyone, because I think I need to reshuffle my names in the bucket.
I haven't
And
gotten a pre
Yeah,
I
yeah.
haven't gotten a white elephant.
oh, that's
That's
true.
I
That's
just
true.
I just stole
He
Jesse's.
stole.
Yeah.
You stole
Well,
Dave's.
would you
Oh,
like me to
mine.
throw
Oh,
your
I
name
stole
back in and we
Dave's,
draw
right.
names again? And we can start a new round. Let's do that. Let's start a new round. So that way, this next topic, when it comes up, someone can immediately steal it after I assign it, or but keep in mind you can't steal again. Okay.
Mhm.
So for the next one, I have uh, rising delinquency rates in auto and mortgage, and the name I have is Tom.
But I can't steal.
Right,
You're
you-
saying
No, we can
That means you're
steal
stuck with
confused.
that.
Someone can steal it from you.
from
Yeah,
you.
so we'll give them a second. Would anyone like to steal that, or do we not want Tom to talk about delinquency rates?
No, thank you.
It's like the student loan, Cole.
So I'm sitting here holding Dave's AI adoption, and now you're giving me delinquency rate.
How about I steal it?
Okay, go ahead.
I don't because I don't know. I feel like I need a gift too. So delinquency rates in auto and mortgage, I think they're very interesting. Trends that are occurring. To me, of course, we have seen the rise in rates that we've observed in auto. specifically with the 60 to 60 plus rate outside of write-off. Write-off hasn't increased to the same pace that we've seen from a pure delinquency based standpoint. But one of the things that to consider about auto is that in the subprime sector, and we've talked about this over time, is that it is the top of the payment hierarchy. So where much of the delinquency has been occurring, or where people have been going delinquent in the near prime or prime, they're moving back down into the subprime category. And I think a lot of that does have to do with the stimulus drying up now over time and a new equilibrium starting to be established. And we're seeing some of those trends in some of the other statistics that we've been measuring. But of course, as we head into the new year, I think it's going to be critically important to manage and watch, because we have seen when someone goes delinquent on their auto, they're 10 times more likely to go delinquent on a credit card in the next month. So just some things to think about from a stat standpoint.
And I was going to add some of the things we've seen also from situations such as delinquent populations, the change in how consumers are reacting to some of these metrics or realities. And when I presented, for example, in November, I was researching the spending potential this season. We were thinking consumers were going to be cautious, consumers were going to remain or cutting back on discretionary spending. Some of the auto market is reflecting that. They're now seeing, should I really spend on a new car, or should I maybe downgrade and keep my car as currently is for as long as possible before, of course, maybe parts and other pieces are hit a little bit harder from tariffs. But are there other ways to manage those needs and my spending? Should I move on to a used car segment instead? So also I'm seeing a little bit of a change again in the auto market, in particular in the holiday spending with that. I think it was you that talked about the pivoting towards, again, more value and meaning. And then Jesse referred to how to use tools like AI to get the best deals. I think consumers are now leveraging what they have at hand and the reality of when they have limited spending to new scenarios, right? That could be also.
You bring up great points around
reasonable.
affordability in particular, and I think that is such a critical point on the individual level, debt to income or disposable income type of capacity, and especially on the high end, because there are people, even though delinquency rates have been on the rise, they're doing quite well, and that does transpire in the K overall. So with the next topic.
I think it's got to go back to Tom. He just lost his. So
It does go back to Tom. So with this one, I am going to now I'm not going to offer any form of judgment, so you can determine whether or not this is, it's a very interesting one to me, a present that is wonderful to you, or coal. And the topic you get is equity market resiliency.
Oh, that is a good one. That could be either. Do I stay in character and go with the coal, or paint it as a present? I'm going to start with it actually being a present, because that has been one of the more surprising developments and stories of 2025 is the market resiliency. I mean, you think of all of the things that really could have brought it down, and briefly tariffs did. We had a swoon when tariffs first came in, and we were pivoting towards looking ahead to trade wars and uncertainty around what the tariff rates were going to be, what were going to be implemented, and all that. And then you add on policy, uncertainty, rate uncertainty, international conflicts, all of these things that in times past have not been good, and yet the market, when we look at 2025 as a whole, has been pretty strong. So I think on the surface, kind of like AI, it's a present. But if we start pulling that present out, and dissecting a bit, there's some coal hidden in there, because it's a very heavy
Yeah.
markets,
Mm.
dominated by AI and by, specific companies, and a little heavy and concern about a bubble and concern about, massive corrections. So I think as a whole, yeah, I like opening that up. If I'm looking ahead to 2026, am I going to want to hold on to this gift? No, I may want to pass it off to one of you guys.
I like it.
Yeah, I think
Yeah,
the thing when I'm considering like the the various things that are occurring with equity markets, is the we know that the as the equity market performs, so does the top end of the market from spend standpoint. So it kind of carries things through, and where the thing we need to watch is what is driving that resiliency, in the midst of things like tariffs, rate cuts, et cetera. We is the market moving up from financial results because of price increase, and where does that potentially change from an impact standpoint if individuals aren't able to afford things in the future. So that is the part that I'm particularly watching. I would agree with you that it
Yeah.
is it currently is a wonderful present, but like fruit, it could we could it could expire or
Go.
reach its expiration date at some point, or
Yeah.
milk. Um,
Yeah.
so the next one
And
that I've got was it. Did
But
anyone want to weigh in else on that? I heard. Yeah.
no, I
Maria?
was going to add,
Mhm.
no, I was going to add, what you called out, that it's mostly driven, and Tom, you mentioned it as well, by the affluent group. It's like 11% that drives 73% of the total
Mhm.
assets. The 56% mass market that holds less than $100,000 only
Mhm.
holds less than 3% of the total assets, and they have limited even savings as well. Currently, our average is below 5%. So as you said, it depends, and it's this affluent group that is driving that household wealth mostly. I was even looking at the spending. They are the ones that are able to pivot and still look at more luxurious vacations or gifts, even using AI for that, but still outperforming, of course, the broader trends, even though they look apparently very positive, and they're projecting a 4% year-over-year growth in shopping this season. But it's mostly
Yeah.
coming from that group.
Yeah, and I think you could bring up that great point, especially on the percentages of people sitting in the affluent, as well as how that relates to spend. So there's a very small group that is holding up the equity markets, the spending, and otherwise, and that distributional spread is what we need to make sure we're actively watching for future impact. So I'm going to move on to the next present in the interest of time. So my next person that I have is Jesse.
Ooh.
All right, Jesse.
No
Uh,
call.
for for this
No.
one, yeah, it's a more recent topic, and you can decide whether or not this is Cole or Wonderful Present as a reminder. And the topic is government shutdown, specifically as it relates to economic information.
Ooh. Yeah, that's interesting.
Light topic, huh?
Hard to
Yeah.
yeah, hard to see the present there.
Yeah. You
I
get to
would
keep that,
say
Cole.
yeah. Maybe does
Is there
anybody
a
want to steal
problem if
that?
we can't measure it?
Yeah, I mean, I think interesting topic. It's certainly relevant on the heels of the longest government shutdown in history. Certainly a concern as we move forward, just with the some of the polarization in politics. I would say in terms of the data, though, I think we are seeing the impact to some extent of not having a consistent stream of flow of data. When we think a good example is when we think of the job growth numbers, we entered a period where the Fed was really looking to job growth, given what I had mentioned before about the Fed's dual mandate, meaning that the Fed's trying to look at price controls and where prices are going, and then they're also looking at the growth in the job or labor market. And so not having a full stream of data to make decisions on is certainly a bigger challenge that the Fed probably didn't need. There was some other third party data that could kind of bridge the gap, but it is a concern, and it's certainly a concern with where shutdowns go. Shutdowns impact all forms of data collation, and so that I think is something that we would want to watch, certainly as we get into the new year and potentially seeing impacts from, future government shutdowns. Is how do we bridge that gap, knowing that that data is critical to make decisions that we need.
Yeah,
So
I think you bring up a great point, especially about being prepared. It's much like anything with respect to supply chain interruption, like around something like tariffs, where we're actively finding ways to find information around like employment when we didn't have it, for example, and finding ways that we can still make economic recommendations and considerations based on new information we have. So I think on one hand, the impact of not having the data is part of the goal, but our resiliency in trying to find additional sources was part of the present to me.
yeah, and I think that's a good point. I think the complementary nature of the government data that we see, along with where third parties, including ourselves, when we think of some of the things that we've implemented this year, Market Pulse Index, a good example. So I do feel like there's a good complementary nature there that I'm sure we'll continue to see nurture, in the coming year.
Yeah, and I actually, if I could pull the lens out a little bit and look at the government shutdown, not just in terms of the impact to the economic information that we've been talking about here, but just in general, I think that same theme applies. Like we saw with the lack of information how we adapted and we made do with what was available, and we found new uses for existing data and came across new data. Um, but I think a little bit of that can be applied to the shutdown itself, at least from what I recall from previous shutdowns, in terms of how industry and the markets pivoted and sort of. I wouldn't say that we shrugged it off like it was no big deal, because it was a big deal and there was real impact, but we carried on in a way that I don't recall us in previous shutdowns. And so I don't know if it's just we're getting used to it at this point,
That's a sad thought.
yeah, which is a sad thought, or if it just speaks to our increased adaptability, or maybe both.
Or
I
resiliency,
love the
Tom.
adaptability. Yeah, adaptability, resiliency.
Yeah.
That's very a very thoughtful word, I feel. Um, Okay, so my next recipient of a gift is going to be Maria.
Oh,
And Maria, I would like for you to comment on consumer response to in the spending world. And you already
okay.
hit on that a little
I
bit.
hit it, yes. But I love that Jesse brought up some of the additional insights that we can grasp from tools such as the Market Pulse Index. During November, we were looking specifically at that and expecting potentially that the baby boomers will be the only ones having some flexibility with their spending during the holidays, the younger generations cutting back, being very cautious, very thoughtful about what to get, if they would even be able to purchase gifts for friends and family. And we have seen that reflected through the Market Pulse Index that positions the generation differences or regional score tier differences, etc., in a different light, giving us a more well-rounded perspective. And I'm glad. I know that Tom, you're evaluating, of course, the updates to that, but from the recent, as I was mentioning before, insight into spending, it seems it's projected to be even a better season than we believed it would be, with that 4% increase year over year, with thoughtful giving still being at the center and clearly driven by the higher income groups. That's still a thing. We are seeing improvement in terms of, again, having the younger generations leverage AI to be more thoughtful and be able to shop around with pricing opportunities through AI optimization, so to speak, of searches for specific gifts. And again, it's aspects such as market pulse index into the 2026 that might give us more insight into these ways that the generations might find shortcuts when the financial situation is not as promising as it is for older or higher income earners.
Thank you so much. What I'd like to do now is I think that might be the end of our gift giving, but I want to pivot to a look ahead, and this is going to be in the form of resolutions. So this will be a free form versus me assigning topics to each of you. So hopefully you came or knowing what we've already talked about, I'd love for you to share some additional thoughts around things that from a look ahead perspective, and you could take whatever approach you want here, whether it's the perspective of coal or the perspective of a wonderful present that you may be expecting, or just some things that you might see from a change standpoint. And we know that the world is ever changing. And so I'll start here. Just this morning, I took my son to his orthodontist appointment. He's going to be getting braces, and apparently, I'm learning from him and others that braces and glasses are now cool. And I was like, okay, it's a very different world. And I don't know if that were the case, I might not have been a data scientist and an economist in the future. So so jumping into the resolutions, let's go ahead and start with Jesse.
All right. If I think of one that could be maybe more of coal now, but I think doesn't coal turn into a diamond with high pressure?
It does.
So there's my metaphor there. I would say I'm watching closely the job market and specifically job growth, looking at job openings. Do we see businesses creating opportunity? It just feels like that's such a lifeblood of our economy when you think of what a job means to a household and the income that it brings. And so I'm going to be watching very closely those job numbers. We watch the Jolt survey. We watch I can't even actually talk as there's so many metrics that we look at, but really just monitoring those metrics to see where job growth goes in 2026, because I think that's going to really be a good telling sign for what happens with, largely with the economy and the moves that the Fed's going to make.
Well, I'm going to throw something out.
You want to add to it?
Yeah. Oh, go ahead and add to it. I was going to switch.
Oh, you're doing your own. Great. Yeah, just hop in then. That's perfect actually, because I was going to ask. I was going to call on volunteers.
No, I was going to throw out sort of a resolution form of prediction, and that is
perfect.
Maria mentioned earlier we've been talking about the K-shaped economy for 3.5 years. Originally, we were talking about K-shaped recovery, and then that morphed into K-shaped economy, and now it's just the K. Because we have been seeing that growing gap between those who are doing well, recognizing wealth from the markets, from increased housing prices, from increased savings, increased income, and so forth, and those who are struggling, because of the pressures of inflation, of the pandemic, of labor markets, and so forth. And that gap between those populations have been growing, and fewer people in the middle, which is why there's now the K. I'm looking ahead to 2026 as potentially that stabilizing, and we've talked about the market pulse index here, which is our way of looking across all of these different financial dimensions of a consumer or a household's life, not just credit, but savings, spend, debt, and all of these other things. And we're starting to see early signs where maybe that bottom part of the K is starting to turn around again. Still early. We're closing off 2025. We can't say that that's been the case for the year, but I'm hopeful that is the trend going into 2026, and that we can start talking about these populations not being as divergent as they were before. And of course,
yeah. So Tom, when you say turning around, are you referring to it as stabilizing or improving?
it's both.
Okay.
It is stabilizing at the very least within the populations, and in some cases some of those populations within the bottom part of the K are actually turning up faster proportionally than even some of the populations in the upper part of the K.
Cool. Well, thank you. I look forward to that as well. It's a very active, as you already know, an interest topic to me because of the various things we're observing from a correlative effect that we're capturing, and really, from my perspective, only able to capture through the Market Pulse Index. So, with that, I'll open it up for anyone else have any resolutions they'd like to offer.
Yeah, I'll go. If I'm looking forward, really, I think it's around the household financial cushion and overall credit health, kind of building on the Market Pulse Index view of things. And so, um, what's the current, focusing on household debt to income and GDP ratios, right? So, what's the overall level of debt relative to the economy size? Um, Thinking about it then from the overall American perspective, again, personal savings rates. Again, low savings rates suggest that many consumers have then depleted their excess pandemic savings, relying more on debt for spending, which then goes to my last point, delinquency rates. Really, again, um, auto, card, student loan. As consumers lose their excess capacity, as they're balancing affordability, are those then translating into rising delinquencies? That's what I would watch out for. So I'm hopeful, but cautious.
Good points. And I think Maria,
I've
you may
got
be the one that's left to offer a resolution.
Yes, my resolution, I'm following in a way the wait and see approach that was called out by the Fed. I think 2026 will be a little bit of a settling of the dust kind of year. So many things happen in 25 that, all these, and specifically the consumer reactions, as I said, specific to spending at the end of the year, specific to how to approach switching cars or buying a new car versus a used, or not even making that move. I'm looking at even the impact to payment hierarchy. We know that student loan came back into play in 25 at the bottom of the list, typical historic observation. But I'm wondering if we'll start observing a new shift like we did years back when mortgage went from the top to the middle ground, and auto and home equity were at the top. I'm envisioning not a resolution, but I'm curious in this wait and see approach to observe what the data and the actual trends in consumer payment hierarchy, how things switch around given the new idea on how to address affordability limitations, juggling of multiple debt commitments and other household objectives. So that's my.
Great. Thank you so much. I do want to just close it out here. Thank all of our listeners, all of you here who have participated in this conversation. Love working with each of you. So thank you to Maria, Jesse, Tom, and Dave for joining me today. Your insights today and throughout the year have really helped me both from a personal standpoint, but in addition to that, being able to work through these challenges with our with all of our stakeholders, from our customers through our investors, and our ability to try to uncover the relevant themes of 2025. And I'm really looking forward to heading into the next year, and as we cover new trends that are happening in the various industries and verticals in the U.S. market, and how we can connect these insights with actions, and how to navigate through that uncertainty that we've been experiencing. And again, to our listeners, thank you. I hope you enjoyed the topic today. And as a reminder, your feedback is important to us and critical to conversations like the one we had today. If you have any additional questions, suggestions, or would like to reach out in any way, we even take guests on podcasts, please reach out to us at riskadvisors@equifax.com. And we look forward to hearing from you.